The trade conflict between Canada and the United States is a defining moment that could reshape the global economic landscape, particularly in sectors like automotive, energy, and agriculture. What began as a ripple effect from Trump's protectionist tariffs has now become a full-blown confrontation with wide-reaching consequences not only for North America, but for global trade as a whole. The latest move by Canada, proposing a 100% tariff on Tesla vehicles, has sent shockwaves through the auto industry and could have a lasting impact on the broader economy. This article dives deep into the potential ramifications of this trade war, examining its effects on various industries and countries around the world. Canada opens the door to EU electric cars, a major blow to the U.S. auto industry. The U.S. and Canada have long enjoyed a close trade relationship, particularly in the automotive sector, where they exchange billions in cars and materials like aluminum and steel each year. However, since the Trump administration introduced tariffs on various Canadian imports, Canada has been under increasing pressure to respond. The proposed 100% tariff on Tesla, a symbol of American innovation in electric vehicles, could disrupt not just the automotive trade between these two countries, but could also affect global trade dynamics. For years, Tesla has been at the forefront of the electric vehicle revolution, holding roughly 70% of the U.S. electric vehicle market. A tariff of this magnitude would raise the price of a Tesla vehicle in Canada by as much as $5,000 or more. As Tesla's vehicles become less affordable, Canadian consumers are likely to turn to other electric car brands, particularly those from the European Union, which could be exempt from these tariffs. This scenario would shift the balance of power in the electric vehicle market, giving European brands a significant competitive edge over American automakers in Canada. A ripple effect across North America, Tesla's challenges and broader industry. Impact. While Tesla would undoubtedly bear the brunt of the tariff, the effects would extend far beyond the company. Canada's auto industry is closely intertwined with the U.S., and any disruption in trade could create a domino effect. The North American auto industry produces over 2 million cars annually in Canada, with many of those vehicles being exported to the U.S. If a 100% tariff were to be imposed, it could significantly damage this trade flow, causing factory shutdowns, widespread job losses, and even putting a strain on global supply chains. The direct consequences for Tesla would also be severe. The company could see its stock value plummet as a result of lower sales and profitability, and its long-term prospects in North America could face significant hurdles. For investors, this could signal the beginning of a downturn in the electric vehicle market, making it more difficult to justify future investments in the sector. This could have the unintended consequence of slowing down the growth of electric vehicles overall, at a time when the world needs accelerated investment in green energy and sustainable transportation options. Canada strikes back, a bold and calculated response to Trump's tariffs. Canada's decision to impose retaliatory tariffs on U.S. goods is not just a response to the tariffs on cars. It represents a broader strategy aimed at diversifying Canada's trade relationships and reducing its reliance on the U.S. The U.S.-Canada trade relationship is valued at over $800 billion annually, and any disruption to this flow could have dire consequences for both economies. Rather than backing down, Canada has taken bold steps to protect its economic interests, including imposing tariffs on key U.S. exports, such as steel, aluminum, and agricultural products like beef and dairy. But the tariff imposition was only the beginning. Canada's government has also moved aggressively to reduce its dependence on the U.S. by signing new trade agreements with the European Union, Asian nations like Indonesia and Ecuador, and even strengthening ties with emerging markets. These efforts to open new markets will not only benefit Canada's economy, but also present a challenge to the U.S. by weakening its grip on its closest trade partner. Strategic alliances with the EU, redefining global energy and tech supply chains. Canada's most recent strategic moves have included significant investments in critical sectors like energy and technology. In an effort to reduce reliance on China, Canada and the EU have formed a new strategic minerals alliance to secure the supply of crucial materials such as lithium, cobalt, and nickel, which are essential for electric vehicle batteries and renewable energy technologies. This alliance has the potential to disrupt China's dominance in the global supply of these materials, shifting the balance of power and offering Europe and Canada greater economic security. This new partnership has implications not only for energy independence, but also for the global green energy transition. By establishing a reliable supply chain of essential minerals, Canada and the EU are positioning themselves as leaders in the future of energy production, which could challenge the dominance of the US in these critical sectors. The impact of this alliance will be felt on a global scale, especially as demand for electric vehicles and renewable energy solutions continues to grow. A shift in global trade, Canada moves away from US dependence beyond just tariffs and trade deals. Canada's response to the US's protectionist stance reflects a larger shift in the global trade landscape. For decades, Canada's economy has been heavily reliant on the US as its primary trading partner. However, the growing tensions between these two nations have prompted Canada to seek out new, more diversified markets, particularly in Europe and Asia. The Comprehensive Economic and Trade Agreement, CETA, with the EU, has already significantly boosted trade between the two regions, reaching a record high of $100 billion in 2021. But perhaps the most important development is Canada's shift in energy exports. Historically, nearly 97% of Canada's oil has been sold to the US. However, with new agreements in place with countries like Japan and China, Canada is diversifying its energy exports, reducing its exposure to US tariffs and increasing its global energy market share. This change in strategy signals a fundamental shift in the global energy supply chain and represents a major challenge to the US, which now finds itself competing with other global powers for access to Canada's energy resources. The global agricultural fallout. US farmers feel the impact. The trade war between Canada and the US has not only affected the automotive sector, but also has far-reaching consequences for agriculture. The US farming industry, which has long relied on Canada as a key trading partner, is now facing significant challenges. Canada has imposed tariffs on key US agricultural exports such as corn, soybeans, and beef, creating a crisis for US farmers. These tariffs have made it much more difficult for farmers to sell their goods to Canada, causing prices to drop and driving many farmers into financial ruin. At the same time, Canada's retaliatory tariffs have created an opening for countries like China and Mexico to increase their agricultural exports, further exacerbating the challenges faced by US farmers. The long-term effects could be devastating, as farmers may be forced to sell their lands to large agribusinesses, further consolidating the industry and leaving many small family farms struggling to survive. Energy crisis. What happens if Canada cuts off the US supply? The US's reliance on Canadian energy supplies is another major vulnerability that could be exposed in this trade war. Canada is the largest supplier of oil to the US, accounting for around 60% of its oil imports. Canada also provides significant amounts of natural gas and hydroelectric power to the US. If Canada were to cut off these supplies, the consequences would be severe. Energy prices would skyrocket, forcing industries that rely on stable energy prices, like manufacturing and chemical production, to reduce output or even shut down. Moreover, the US could face energy shortages, as it struggles to secure alternative sources of oil, natural gas, and electricity. This would disrupt not only the US economy, but also the global energy market, as countries around the world seek to secure their energy supplies from Canada. Conclusion: can the US adapt to this shift in global trade? The escalating trade war between Canada and the US marks a significant turning point in global trade. As Canada diversifies its markets and strengthens its alliances with the EU, Asia, and emerging economies, the US risks losing its position as the dominant global trade power. Canada's bold steps to secure its economic future, including expanding trade agreements, diversifying energy exports, and strengthening its strategic alliances, are redefining the global trade landscape. The question now is whether the US can adapt to these changes or whether it will be left behind in a rapidly shifting global economy.